Good morning, everyone. This is John Clark with Heffernan Retirement Services. Wanted to thank you all very much for joining us today as we're going to be spending a little bit of time just reviewing some of the things that came about in the retirement plan industry space that you may have missed during the pandemic. Obviously, it was a very busy time for everybody and there was a lot of scrambling and wanted to just kind of give a quick refresher for some things you may have missed that are big changes that may be benefit for you when you're looking at your retirement benefits for your employees. As a little housekeeping item, the phones will all be on mute for the call. You can use the question feature to ask a question. And this will be recorded and there will be a copy of the slides available for those that want them. So please feel free to use the questions if you have those, and then you can also use the chat feature for others. So thank you all for joining us. As I mentioned, I'm John Clark with Heffernan Retirement Services. We are part of the Heffernan Group and are dedicated to focusing on advising and consulting on retirement benefits for companies, nonprofits. Our team has over 120 years of experience. I've been with Heffernan now for almost 15 years. Again, we advise on almost $5 billion in retirement plans for now nearing almost 200 organizations. So we're very proud of the services we provide. We have the benefit of knowing some of you and some of you knowing our broader organization, the Heffernan Group. But we're here and really a dedicated team, mostly focused on the West Coast, to be a resource for you if you have questions for any of the materials we go through today. If you work with Heffernan on another line of business and wanted to look at your retirement plan, we'd be happy to help you and give you some guidance around the topics we're going to be going over today. So again, today's topics, there's really four broad topic areas we're going to be looking into. The first one is just a Department of Labor and IRS enforcement update. In spite of the pandemic and everything going on there, the Department of Labor and IRS that regulate retirement plans have been very, very active in what they've been reviewing and finding judgments and enforcement results. We're also going to be going into some of the current administration's retirement-related initiatives that may affect your plan, both currently passed and future proposals, and then future legislation that may be on the horizon that you might want to keep your eye on. Again, there's no formulated bill yet in the House or the Senate that's passed or been reconciled, so there's still a few steps to go from there. And then the last one is for CalSavers, for those of you that are California-based businesses. Just a quick reminder about that deadline coming up. So 2021 was one of the best years ever for the Department of Labor from an enforcement standpoint. They had over 2.4 billion, and yes, that is a billion with a B, in monetary results returned to plans, and that's in terms of restitution paid to retirement plans, both defined contribution and defined benefit, and fines and penalties. They have over 710 full-time people assigned to enforcement. They call these people investigators. They do not call them auditors, so don't be confused about what they do. They opened a little over 1,000 civil investigations and had 208 criminal investigations. Now, before we get a little too worried in this, the vast majority of these compliance results and concerns were really focused around processes, not criminal activity. But that said, almost 69% of the plans that they investigated were required to restore losses to the plan or take another type of corrective action. So the Department of Labor has a very, very high batting average in terms of almost 70% success. And they did also have 72 individuals who were criminally charged. Again, a lot of this is really more process oriented. We don't want you to think that there's a high likelihood of criminal concern for you and your plan, but there are a lot of challenges out there, and the Department of Labor is looking at a lot of things. And Heffernan has worked with a number of our clients who've had Department of Labor audits and worked through those challenges with them, looking what the Department of Labor is looking for. So of this 1,000, almost 1,100 investigations and 2.4 billion in monetary results, what was the Department of Labor looking for? Their top concerns, and kind of if any of you have gone through this Department of Labor audit, they'll send you a list of, we've seen as few as 25 and as many as 45 questions. But the first one that they ask for is they ask for a copy of your plan document, and they ask for the last 2 years of your payroll contributions and payroll into the plan. The reason being is that their number one place that they found judgments are late deposits of deferrals. And what we mean by that is the Department of Labor is looking at how quickly you put money into the retirement plan relative to how quickly you move other money around your organization. And if they find that you move other money around your organization much more quickly than you do your retirement plan, that can be considered a late deposit, and you can have to put an interest payment in and true up the employees on that late deposit. There are some safe harbors you can look at. There can be some processes. Again, not their main concern is not really criminal, but it's really looking at those late deferrals. The second one that they've looked at is excessive service provider fees. Some of you may have seen in a lot of the news, there's been a lot of very large organizations, both public and also universities, sued by a firm out of Missouri called Schichter. They've been going after excessive fees, and the Department of Labor has got in on this well. The benefit is that ERISA does not require you as an organization to have the lowest fees. You don't get a gold star for having the lowest fees associated with your retirement plan. But what they're going to look at is saying, okay, are your fees reasonable for the services that are being provided? And that's the part that you have to work through with your service provider and your advisor, is to say, are these fees reasonable? And there's a lot of tools out there to help you understand what your reasonable services are. Again, some organizations want more services for their retirement plan. Obviously, that carries a greater cost. Some organizations don't need the same level of service, so there can be different fees. So there's no right or wrong combination of fees to services, but you do need to document the decisions that were made and make sure it's benchmarked and understood what those are going to look at. The next one is imprudent investments. These tend to be either investments that are inappropriate for 401k plans due to level of risk or fees or a number of other issues. The next three are a little less common, but what they look at is if an organization's gone into bankruptcy or abandoned pension plan, or for a handful of organizations that have hard to value assets. For example, if you buy an office building and you put it in your 401k plan, that can be a hard to value asset because you don't know exactly on a day-to-day basis what the building's worth, future cash flows, so they look at those a lot more detailed. Again, if most of your investments are mutual funds or collective investment trusts or separate accounts that are daily valued, you don't have that hard to value asset issues. The last one is actually a very interesting one, and this is one they look at, is there are fiduciaries managing every retirement plan at your organization, whether that's the owners of the company, the board of directors, the executive director, CFO, whomever it is. And they've been finding more and more that the fiduciaries don't know what their duties are. So they don't know what their responsibilities are to the retirement plan under ERISA. So one of the things we've done and worked with other organizations to do, whether it's your advisor or your ERISA attorney, is do fiduciary training for your investment committee. And a lot of organizations haven't done that to know, okay, what are my responsibilities under ERISA? We have a short 25-minute video, that we walk fiduciaries through. It's five-minute chunks of the 5 areas of their focus, and then help educate the committee on an ongoing basis about, what's gone on with documents, what's gone on with investment policy statements, where things are changing from a regulatory standpoint. So again, those are the Department of Labor's top concerns. As we always love, there's another partner in this enforcement, and that is the IRS. And so while the Department of Labor looks at those pieces and looking at your document and compliance, the IRS looks at a few different things, but also does come up with the same kind of compliance concerns and get folded into that fines and penalties. One of the big ones that we've seen a lot of recently is how the company handles a full or partial plan termination. During the pandemic, a lot of organizations partially terminated a good chunk of their workforce, depending on what industry they're in, and that could cause the technical definition of a partial plan termination, which is a reduction in force of 20% of your population or more. There were some things that were passed as part of the CARES Act to give you a little more leniency in terms of how quickly you hired your employees back. But if you've had a partial plan termination, which is that 20% RIF or more, those employees that were part of the reduction in force have to get some vesting benefits on employer contributions and a few other things that you have to document to the IRS and the Department of Labor. So if you did have that, they are looking at what your hiring was. It's not necessarily hiring back the same 20%. They look at what your employee population was at the beginning of the plan year and at the end of the plan year, and kind of seeing, where that was from a total employee standpoint. Mergers and acquisitions, again, how the two plans come together when an organization either merges or acquires another firm, again, making sure you document the decisions that were made. Again, really the focus is on protected benefits. If you're merging together two organizations and they have different vesting schedules or other protected benefits, how are those handled for the employees? Because there are things that you can't change just because two organizations have merged together and their retirement plans need to come together from a 401k, 403b standpoint. Again, looking at the non-discrimination tests, one of the other big ones that we've gone through, and we've seen this more and more, is what's the definition of compensation? A lot of those challenges are is it W-2 wages with exclusions? Are you including fringe benefits? For example, if you provide a parking allowance or a cell phone allowance, is that included or not included in the form of definition of compensation in your 401k plan, 403b plan? Again, taking a look at what your document says and make sure you're enforcing it. One of the other big ones is bonuses. Do you allow for bonuses to have their own deferral rate, or do their bonuses have to be deferred at the same rate as all of your other contributions? Again, your document will dictate which way that goes, and making sure that you follow that for all employees is the important step. Again, 2022, middle of this year, is a plan document restatement year. So many of you are probably already in the process, if you're in a 401k, 403bs was a few years ago, of restating your 401k document. This is a great time to look at how you're doing that, making sure you have your definitions of compensation right, make sure your plan is functioning the way you want to, making sure that it's got the right pieces in it for making your plan successful for your employees. You have to go through, and many organizations are having to pay a restatement fee anyway, so if you want to make a change and refine those definitions of compensation or how bonuses are handled or automatic enrollment, this can be a great time to go check that. Again, plan fees, are one of the areas that we always look at and are a big area of focus. Again, it's not lowest fees, it's how the fees are balanced against services and how they're looking at those fees. And then just documentation, again, is the biggest thing. If you have an investment advisor taking minutes of your meeting, if you have a benchmark taking minutes of the decisions that are made, they're going to be asking, if you ever get one of these audits, for documentation on why you made a decision you made. And that's where having an investment committee and having those decisions documented are very, very important. One of the other things, lack of internal controls and incorrect data on 5500s or late 5500 filings. The Department of Labor and IRS increased their fines and penalties during the pandemic for late filings. So those have gotten more and more expensive for organizations. So I'm going to pause real quick since I've been talking now for almost 15 minutes, and hopefully none of you have fallen asleep, but wanted to just kind of see, before we get into the next slide, what is your current ESG or environmental, social, and governance investment status? A lot of these organizations, a lot of these types of investments are socially responsible. They look at more than just fiscal returns, looking at things beyond just growing participants' money and seeing it be a place of growth in a lot of the industries. So we're going to give a minute to collect the responses. Right. Okay. And go ahead. So it looks like about where I would have thought. Oops. So let's see. Here's the results. So about equal, 13% offering ESG, 13% not considering it, but 75 not currently offering ESG investments. And that tends to be, an area that we've seen more and more organizations considering looking at this, but there's been, frankly, a lot of questions around, what the rules and regulations are for ESG. So we wanted to do, for those of you that are interested in this or looking at exploring it, we are seeing a lot of employees, especially in the younger age brackets, but across all age demographics groups, saying they want their money not just to grow for themselves, but to do good while growing. And that's where the regulations under the previous administrations were final regulations, or so we thought, because everything changes administration to administration. Said, they put in factors and said you can offer ESG plans in retirement programs, but you have to go through a process of reviewing those, and you are still a fiduciary to those investments. There's no safe harbor for you offering an ESG investment. So, you have to go through the process of evaluating that ESG fund like you did any other investment, and, monitor it and make the case that it makes sense for the organization and for your employees, without giving it credit saying, well, we offer it because it's ESG. You have to look at it from a financial standpoint, a return standpoint, and a fee standpoint. So those regulations were finalized, and then a new administration comes in, and new regulations have been published to be a little bit more favorable to offering ESG investments. So the new regulations came out in October of last year, and they can go through the process of considering ESG factors in investment selection. One of the other big things it did is that the previous administration's rule said that you can't have ESG investments be the default. So you can't say our default option is a qualified default investment alternative that is socially responsible. It also eliminates the pecuniary or financial distinction for analysis purposes. Again, it didn't get into the details of what constitutes an ESG investment. And this is one of the areas of this type of investments that's new and a little challenging, is a lot of times you can have an environmentally focused fund that may score very, very well on its carbon score, its oil score, but it might, not quite have the same social or governance score because they're mainly focused on the environment. Again, it didn't get into addressing what the sales practices are in terms of these ESG companies coming out to organizations and individuals discussing who they are. And a lot of it is, again, there is still no safe harbor. So you can currently, under the interim regulations, amend your investment policy statement to include ESG as an option in it, and discuss how you're going to evaluate ESG options. You as the fiduciary for the plan or the fiduciary advisor you hire still are on the hook for performance and fees and all of those other different pieces. You don't have a safe harbor just for offering ESG to say, well, we offered ESG, it was important to our employees, and we didn't monitor it, but it was social and good governance and it was there for them. The performance has to match, and it has to be, relative to the risks it's taken on, a reasonable investment, reasonable fees. So, it's not just we offer ESG and we set it aside and don't look at it. It's we offer an ESG fund, and is this continuing to be the right ESG fund, and how do we monitor where we go from there? So we are seeing a lot of growth in the ESG industry. And there's a lot of debate still about how all these different pieces are going to come together in terms of the environment, social, and governance, and how do we evaluate these companies, both domestically and internationally, and there's still a lot of pieces in play. So that's where we do think it's going to be an important area to consider going forward. We've seen a lot of employees asking for it just as an option. Frankly, we've seen fewer employees actually use it as an investment option rather than employees asking for it, but it is something to be aware of, and when working with your advisor and fielding those requests from employees, what are you going to look at and continue to offer? So that's kind of where we are on ESGs. The next piece that we're gonna have you kind of weigh in on was way back in the before time of December of 2019, the Secure Act was passed. And, you know, we kind of laugh and kind of joke at that most people very quickly pushed the Secure Act out of their mind and focused on the CARES Act, which provided a lot of focus for individuals to help alleviate financial struggles that were caused by the dislocation of the pandemic, stay-at-home orders, all those different pieces. So the Secure Act was part of that. Again, bipartisan bill that was signed by the former administration and had a lot of tax effects and looking at that. But as the majority of you who remembered that there was a Secure Act, said, yes, there were retirement provisions in the Secure Act, and they do affect a lot of 401k plans. There were some pieces in there for 403bs as well, but a lot of that was looking at it. And again, it seems like, for a lot of individuals, with looking at this Secure Act, oops, let's see, manage polls. How do I get my poll? Okay, so that's where looking at the last piece of the Secure Act. Let's see, I'm trying to get my page to change back. All right, close. Hide. There we go. Now, okay. My apologies. So again, the Secure Act was signed in December 20th of 2019. Again, there were a lot of provisions that affected IRAs, retirement plans, 529 plans, tax rates. Some of the provisions took effect in 2020. Some of them actually didn't come into effect until 2021. But what were those Secure Acts that are going to affect the retirement plans? One of the biggest provisions that was in there that I think a lot of individuals has missed was pooled employer plan, or open MEPs, also known as PEPs, or pooled employer plans, became an option for organizations. Again, a lot of the focus of the Secure Act, as there was also with Cal Savers and Oregon Saves and a number of other organizations, was focused on broadening the availability of retirement plans to the American workforce. Generally, it's been kind of studied that about half of the American workforce doesn't have access to an employer-based retirement savings plan, which is a real challenge. Again, those that have 401k plans are great, as I imagine many of you do offer those, but that's where we, have been focusing on, and regulations have been focusing on broadening access and then broadening savings. And that's where pooled employer plans came into play, or PEPs. They allow unrelated employers to participate in a single retirement plan. Again, multiple employer plans were usually sponsored by associations or other organizations that had a common nexus together. So whether it was the American Bar Association or the National Association of Car Dealerships, they had a common nexus of their association. Now, unrelated employers can pool together starting in 2021. Again, the benefit of this for smaller organizations that can be hard is that you get economies of scale for being a larger organization. You can outsource a lot of the fiduciary work to a third party. And again, you can have that PEP kind of be a larger plan for smaller organizations to band together to get more economies of scale and services that larger organizations can get on their own. Again, there is only one plan. So the pooled employer plan files 15500. You don't have your own plan. Specifically, you join the pooled plan. One of the other big pieces was part-time employee coverage in 401k plans. So for organizations, for-profit organizations and 401k plans, starting in 2021, long-term part-time employees, and that's people who work but less than 1,000 hours but more than 500 hours in 3 consecutive years, have to now be made eligible for your retirement plan. Again, you don't have to offer them employer contributions or change the vesting, but you do have to offer them coverage. And this is, I think, one of the things that was greatly missed by a lot of organizations is how are you handling your long service part-time employees? because you do have to look at that group now that works more than 500 hours, may be excluded by the plan document because they work less than 1,000, but how are you tracking if they hit that 3 years in a row, 500, and have to be allowed to be eligible to participate in the plan? So this is something to look at. If you exclude part-time employees, to review with your advisor, your record keeper, your third-party administrator, what you're doing with this population. Again, as we mentioned, 2022 is a restatement year, and a lot of organizations are saying, I don't have many part-time employees, so I'm just going to include them in the plan, and so I don't have to count those 3 years and the 500 hours. Some are saying, I have a lot of part-time employees, that's a huge change in the way my plan is run. I just need to come up with processes for monitoring these. Again, it's up to you as an organization in terms of how you want to adjust your plan, but we do see organizations having to make some changes to how they look at those part-time employees. The last two pieces are around lifetime income and lifetime income disclosures. Again, the final interim regulations, which is the wonderful way that the government describes things, is final interim or interim final, came out on September 18th. So starting on the June 30th, 2022 statement, so not the statement your employees are going to get next for their March 31st statement, but their June 30th statement will now include a lifetime income dollar figure for them. Now, most employees don't look at their statement every single month or year or even every quarter when they get it. But the reason that this is something that we are going to encourage you to consider and look at working with your advisor on how you're going to communicate this is the way that they're calculating this lifetime income disclosure is going to make a lot of your employees very, very discouraged, because what they've came up with as a rule to do is they're going to look at your balance as of June 30th, 2022, and say, based on how many dollars you have in our plan, what retirement income stream would you get today, assuming you retired today? Now, for your employees that are 65 or 70, that's a useful number. For somebody who's 30, they're going to make years of contributions into their retirement plan. They're going to have years of appreciation, hopefully, and that number is going to be meaningless to them. So your 30-year-old who has saved, $10,000 in their plan will get a number saying you're going to get $50 a month in retirement from your 401k. So a lot of record keepers have come out with lifetime income scores that include those future contributions and expected future market growth to get them a better number, but this statement, as legally required, did not actually probably come up with what the Department of Labor was looking for, or the legislators were looking for when they came out with this regulation. So it is something you're going to want to get in of requirements. This is going to be done by the record keeper. So whoever your record keeper or third-party administrator is, this is on them to produce for you. But that said, your employees aren't going to necessarily understand what this number means and may be very confused by it. The other piece that came out of this is that you can now, there's a safe harbor that was created for offering basically lifetime guaranteed income in retirement plans. A lot of 403B organizations may have had this already in terms of essentially looking at guaranteed income up for life or different types of annuities in your 403B plans. But this is now something that is available in the 401k plan. Again, it'll be something to review with your advisor that you'll be looking at, but that's where it's something you'll look at. And a lot of these provisions don't have an employee size exclusion. So whether you have 5 employees or 10 employees or 150 or 1,000 employees, all these rules and regulations still apply to you. So again, there's a lot of things to look at. There are some changes that are going to be needing to affect how you function your plan and things you'll want to consider going forward. And that's where, as we get to the other act that was passed very, very quickly during the pandemic was the CARES Act. The CARES Act was thrown together to try to be a wonderful benefit for the employees, but because it was brought along so quickly and a lot of record keepers didn't have their systems capable for managing what the CARES Act made available, different record keepers came up with different levels of accepting or including CARES Act provisions in your plan document. So again, there's plan document amendments are here due in 2022, but you'll want to go through with your record keeper or TPA and go through which of the CARES Act provisions your plan adopted. Some providers were opt-in, some providers were opt-out. So some organizations, you accepted all of these CARES Act provisions. Some of them, you didn't accept any of them unless you went through them. So you'll have to go back and talk with your record keeper, document what decisions you made, document what decisions they made on your behalf with a negative election. So again, there were a lot of benefits in there. Most of them have expired with the exception of really two. And that is where for any of your employees who took a CARES Act distribution or a CARES Act, or who took a CARES Act distribution, you have the ability still to repay any of that CARES Act distribution you didn't need back into the 401k plan and lessen the tax liability of that. So one of the unique things they did was increase the loan distribution and also, waive for a 3-year period the hardship withdrawal tax penalties. So at the end of 2023, anybody who took a CARES Act distribution and hasn't repaid that money will be taxed on that money. Anybody who repays it, and they have up until the 3rd year, can claim a tax benefit on what they repay or may not own any tax at all. So again, people kind of think, oh, the CARES Act is behind us. Two things, just one, make sure you document what you did or was done for you, and two, making sure your employees know anybody who took a CARES Act distribution still has time to repay it if they don't need the money, or they earned back and have some of it that they can pay back, or all of it if they've moved on to a stronger financial position. So this is our last question. For those of you who are California-based employees only, for those of you that are in other states, this obviously doesn't apply to you, but state-run plans have become a very, very popular option as a way of encouraging employers to set up retirement accounts for their employees. So what these types of programs do, and I believe Seattle has one, Oregon has one, California has one, I believe Illinois and either New York City or New York State are looking at it, are trying to increase the availability, again, like the Secure Act did, of who's got retirement options available for them. So this is where, again, we see this being very, very common. The benefits of the Cal Savers program are that it is easy for employers to run, and then, but you do have to opt out. So that is where, oops, there we go. Cal Savers is a mandatory state-run payroll deduction IRA program. So what that means, and all the other programs are very similar in structure, is that all non-exempt employers who have more than 5 employees as of June 30th, 2022, have to automatically enroll all of their employees after 30 days of employment at 5% of gross pay unless they opt out online or by form. So this means, whether you have 500 employees and very high turnover, if you don't offer a retirement plan, you have to automatically enroll in Cal Savers. If you do offer a retirement plan, you still need to go to calsavers.com and certify that you offer a retirement plan to at least 1 employee, and then you have to opt out. So it's not something your advisor, it's something probably your CPA could do for you, because Cal Savers sent you a code that you need to put in to certify that you don't have a retirement plan. Again, there are a lot of benefits for Cal Savers. It's a Roth IRA where employees can begin saving for their retirement. Again, it has the limits of a Roth IRA in that you don't have any tax liability because you're not taking pre-tax contributions. The money goes in after tax, and then that money is available to the employees in retirement tax-free. There are investment options, and there's no cost to the employer. Again, you have to do the work of submitting CalSavers, but that's where you don't have to pay any fees. You do have to collect out the opt-out forms and allow employees to make contributions. Again, but currently for anybody who has more than 50 employees, you're supposed to be a part of CalSavers unless you offer a retirement plan. And again, there are very, very steep penalties for non-compliance. And the state of California is looking at this, and they're looking at what you said your employee headcount was on your payroll tax forms as of each of these dates. And after 90 days of non-compliance, it's $250 per employees. And after 6 months, it's an additional $500. So it could be a $750 fine per employee. So, again, if you offer a retirement plan, this isn't anything you need to worry about. You do need to go back and kind of take a quick look at how you are opted out and make sure you've gotten that information. But that's where, again, if you offer a retirement plan, your only step you need to do is opt out. But for those of you that aren't currently offering one, there is still things to consider. So I accidentally skipped over this, but this is our looking to the future. There is no bill called Secure Act 2.0. It's become an industry jargon because the Secure Act had a lot of focus on retirement. Again, its acronym was Securing a Strong Retirement. So there were a lot of pieces in that. The big area that we think that they're going to focus on is, again, this coverage and availability. There's a lot of discussion about whether it's going to be automatic enrollment for all new plans or whether it's going to be automatic enrollment for all plans. That remains to be seen. They may change the rules so that all plans by a certain year have to be automatic enrollment plan. But again, they're increasing the credits along with the sticks. So that's where there is that ability to say, okay, we are looking at offering these types of plans, and we're going to get bigger tax deductions for doing it. They're also going to probably include some more rules around target date funds. Again, a lot of participants in the default are target date funds, so they want to have some discussion around where that's going to be evaluated. How do you compare different target date funds from different organizations in terms of passive target date funds versus actively managed versus blends, fees, glide paths. We found in 2008, the 2010 target date funds, which were 2 years away from retirement, were partially had a very wide dispersion in terms of what their risk levels were. And I don't think employees were very aware of that, and the industry's worked to get more clear, but I think that's going to be even more coming. The other big benefits that we see are the ability to quote unquote match employee student loan repayments in a 401k plan. You may have seen some news about this, that Abbott Labs got a private letter ruling from the IRS that allowed them to put money into the 401k plan as a matching contribution for employees paying off the student loan. Again, the how they're still going to work through, but that could be a big benefit because a lot of people are saying, well, I can't match my employee student loan repayments without a taxable event for them, which is actually, there is a $5,250 employer contribution eligibility to student loans through 2025. But, how do I help get them while they're paying down their student loans and unable to save on their own for retirement, get them saving in a retirement plan? The other big one is the benefits for those of you that offer 403Bs. There's been some big provisions that have moved 401k forward, and the 403Bs are going to catch up to that. What we think is that they're not going to continue to say that organizations that offer nonprofits, they'll be able to join a pooled employer plan as well, also get access to CIT investments, ETFs, individual stocks, which currently 403B plans by regulation can't invest in. And you may not want to take advantage of any or all of these, but it'll give larger employers the options because there's instances where collective investment trusts may offer lower fees, or if your plan offers a self-directed brokerage account, 403B individual employees can't trade stocks or ETFs or individual bonds like a 401k plan could. So I think there'll be a further tightening of those two types of plans again, and hopefully that'll be big benefits to the 403B side of things. There'll be, again, increases to the RMDs, which is requirement minimum distributions. Again, they went up from 70.5 to 72. I think the idea will be with longevity expanding, they'll probably push that up. At 75 has usually been the age where they're seeing that come out. They're also going to come up with a different process for lost retirement accounts. Again, for those of you who have former employees who have left their retirement plan with you in the plan you sponsor, can be difficult to track those down. So they're going to work on updating the PBGC's national database to try to track down those people so that they can be aware that they still have money with you. And again, there will be some discussions around, mega Roths and Roth contributions, so that people may be less likely to accumulate the Peter Thiel $5 billion Roth balance that's tax-free. So, there will be a lot of very positive changes, but there might be some things for those of you that have unique plan designs that you won't be able to take advantage of going forward in the future. So again, there's been a lot that we think that has been beneficial in the plan. We do think that there will be, as part of the Secure Act 2.0, more things coming. There is some bipartisan support of a lot of these provisions. There's also obviously some partisan sides where they're going to do a little horse trading to see what gets through and what doesn't. But I think we're overall pretty positive. So again, the kind of big takeaways are just as you're looking at your plan design and looking at your 2022 plan document restatement, make sure you reach out to your advisor or consultant who's working with you to make sure your plan has great documentation about how you adjusted your plan to the Secure Act if you had a lot of part-time employees, how you handled your CARES Act distributions or plan provisions that were adopted. Also, it can be a great time, since you have to go through this restatement process already, to consider things like automatic enrollment or mega backdoor Roth, if that makes sense to you, or auto increase programs, or even changing around how your plan looks at more mundane things like compensation and bonuses. Again, it can be a great time to look at that. Obviously, our team is very happy to help you if we can be of service in that. I'm John Clark. I'm in our Northern California, and I cover that area in Nevada. Sean Kelly is our colleague who's Southern California and Arizona. And then Dallas Otter is in the Pacific Northwest. I got a little lazy and didn't want to list out all the states that are in the Pacific Northwest, so I apologize to Pac Northwest companies. But again, we're here to be a resource for you. We're independent. We're not affiliated with any investments or record keepers. We're here to be independent advisors to clients that need help when it comes to those questions. So I appreciate everybody's time going through this, about 45 minutes this morning. If I'll pause and go through the questions and see if there are any questions that organizations that people have. I do think that a lot of the Secure Act of 2020 will be something that makes it through. Again, that's my personal opinion. I think there's a lot of stuff that people like and will get pushed through. So I do think there'll be some sort of bill, even with it being an election year and the challenges there, because it tends to be positives and can be a nice area of saying, hey, we were bipartisan. There's nothing that prevents somebody from terminating their retirement plan and going into CalSavers. It would be something you'd want to look at, whether that makes sense for you. There are some limitations in CalSavers, but there is nothing about going from one to the other or from graduating out of CalSavers. So if you start off with CalSavers and decide in a couple of years you want to sponsor a different type of plan, you can do so. The only type of plan that has a limitation is a simple IRA. Has to have less than 100 employees to be eligible, and you can't contribute to a simple IRA or a SEP IRA or a 401k plan as an employer in the same year. So there are some limitations there. I do think, again, the markets are off a little bit this year, but we have found that is a good time to try to negotiate with the record keepers for additional services or lower fees. There's been a lot of consolidation in the industry. Principal bought Wells Fargo's record keeping business. Empower bought both Mass Mutual and Prudential. On a more local level, Ascensus bought a company called Newport Group. So there has been a lot of consolidation in our industry trying to get economies of scale and looking at that. When it comes to lifetime income products or guaranteed income products, it's really going to be an organization by organization decision whether these make sense and are something that you want to offer to your retirement plan. Again, the benefits can be, that they provide guaranteed income. The downsides can be, that those are provided by a specific company, so you have to make sure you monitor the risk of that organization, and the reviewing the fees and the portability. How portable is it to you as the employer if you decide to leave an organization? How portable is it to the employee if they decide to change companies? So that's really the question for you in terms of looking at lifetime income, and it's definitely a longer conversation. It's a newer option. Again, been around for 403Bs for a very long time. AIG, VALIC, TIAA-CREF, a lot of organizations in the 403Bs have had annuities since the beginning. But they'll be newer in the 401k plans, and you'll have to look at it from an individual standpoint. When it comes to CalSavers, it is eligible employees with anybody who's over age 18 with W-2 income. I believe it's $500, I believe is where the floor is. You might want to go check CalSavers website to look exactly at what the floor is, but they don't differentiate between full-time and part-time. It's eligible employees over age 18 with W-2 income. Obviously, if you pay somebody, a one-time $200 cleaning fee, they're not a W-2 employee, so you don't have to worry about that. And so that's where, we will provide an email with the link to the recording and a copy of the deck for those who are interested. If anybody wants to reach out to me or a member of my team, we'd be happy to discuss with you these in more detail. But I think those are all the questions I've had come through. Let me double check. One moment. Okay, so I believe those are all the questions. Again, if anybody does have individual questions, please feel free to reach out to me or a member of my team. We're happy to help or discuss any of these in detail or your individual situation. But I appreciate everybody's time this morning, and I hope you have a great rest of your Tuesday.